Now joining us in the studio this morning, Francisco Blanch, head of global commodity research at Bank of America Merrill Lynch. And Francisco is here in Hong Kong to attend the macro conference being hosted by BOA ML. Good to see you once again, Francisco.
Thank you. Good to have me.
All right. Good to see you as well. Good Tuesday. So what is driving commodities these days, the commodity markets?
Well, look, I think commodity markets are being driven by the macro environment. Very much the same, very much the same drivers that you have in equities or bonds right now. Is Europe going to hold up? Is it not? Is the U.S. economy picking up? Is it slowing down? Is the Chinese economy doing better, or is it slowing down too? Those are the questions. I think
those are a lot of questions to be answered. So a lot of volatility in the commodity markets, as we've seen in equities as well. But I guess the question has to be, are these gains that we saw in October, still a month, going to continue for the rest of this year?
Well, Susan, I think commodities, and the key message I think is commodities are going to continue to outperform equities. They've been doing so for the last 2.5 years. And remember, there are three key elements of this environment that we can't get away from. We have developed market deleveraging, right? So banks are delevering, sovereigns are delevering because they have to. But we also have a high liquidity environment, which is supporting economic activity. And the last thing, emerging markets are becoming more aggressive in the use of monetary policy and fiscal policy. So you have one force down, but you have one liquidity boost that's helping you stay there. And then finally, you have emerging markets coming in to counterbalance the weakness in the West. Yeah. So I think commodity markets are going to do well, and I think we'll continue to outperform equity markets in the next year or so.
Yeah, so it looks like emerging markets providing the foundation for these continued commodity prices at lofty levels, higher than we've seen in the last 5 years. But what about China and these PMI numbers? I mean, we were talking to Stephen Engel about this earlier on. Where is this manufacturing growth coming from? It can't be from GDP, considering it's slowing. And then what about the weak global environment, and exports are down in China?
Well, exports are down a little bit, and it's true that some of the PMI figures have disappointed a little bit. But that's precisely the reason why we're seeing a lot of actions being taken by central banks. We've already seen Turkey cutting interest rates, Brazil cutting interest rates,
maybe
Russia,
Australia
today. So there's a long list of central banks that are cutting interest rates. And remember, those that cannot cut them anymore, like the Bank of Japan or the Bank of England, are printing money. So, I think at the end of the day, this is an environment that where we're going to manage to put a floor on global growth. The Europeans got an agreement last week that I think is going to help. It's another band-aid solution, I agree. It's not a final settled solution for Europe, but I think it's going to help at least support growth in the European Union, in the Eurozone, and that in turn it's going to have a positive effect on markets as we go into next year.
Okay, well, let's talk about investing directly into these commodities, because we had a survey of hedge funds come out lately that they expect this spread basically between Brent crude trading in London and West Texas, New York crude as it's better known, to basically narrow. So maybe you can short Brent and go long on West Texas. What do you think?
Well, that's one of the things that we recommended a week and a half ago. We put out a note exactly on this point. Basically, the argument is very simple. There is more rail capacity in the Midwest. It's more WTI catching up than anything else, really. You have Libyan supplies coming into the European market that's going to impact Brent negatively, and you have a lot more rail capacity in the U.S. Midwest, which is going to allow WTI prices to catch up with international prices. Now, I don't think the convergence is going to go all the way. I think we're going to see prices converging to a $10, $12 a barrel range, which is roughly rail parity. Yeah. So we're going from trucking parity, which is $25, $30 a barrel, people trucking barrels of oil out of the Midwest, all the way down to rail parity, because we now have rail available. That's all there is.
Is there shipping parity as well? I'm just curious if all transportation modes are involved.
Well, it's the Midwest, so there's some shipping capacity, but it's all river barges. It's not so we have big super tankers going through the Midwest in the U.S. They don't have the capacity.
Francisco, one more question for you. Sure. Do you think we might see U.S. crude maybe topping $100 a barrel this year?
I think WTI will cross $105 a barrel sometime this year if the economic environment holds. So I do see that convergence happening, again, on the view that the things are not as bad as some people put them.
Okay,
so,
Francisco. Enjoy your macro conference. Good to see you in Hong Kong. Francisco Blanch, head of commodities research at Bank of America Merrill Lynch.